Stop trusting what the market is telling you right now. Because underneath these all-time highs, the financial system is already breaking. The very lifeblood of the market, called liquidity, isn't coming back. It's leaving. And the proof is right on the Federal Reserve's balance sheet. It's been contracting for months. They've been quietly pulling money out of the system. We've seen stress fractures appear in the critical overnight funding markets, the plumbing of Wall Street. And when that plumbing fails, the system doesn't warn you. It just stops working. This is the phase where everything still looks fine, right before it doesn't. So what does that mean for your money, your home, or your investments? Because if you're only watching price, you're going to miss what happens next. And the part that's already changing is the part most people don't even know how to see. To understand the danger, you only need to understand one thing: liquidity. Think of it as the oil in the engine of the global economy. When there's lots of it, money is cheap, and everything from stocks to real estate soars. When it's scarce, the engine seizes up. And right now, that liquidity is being systematically withdrawn. After the 2020 crisis, the US Federal Reserve pumped trillions into the system, an emergency measure called quantitative easing. That was the rocket fuel. But since 2022, they've been doing the opposite: quantitative tightening, or QT. By the time it officially paused in late 2025, the Fed had erased roughly $2.4 trillion of that fuel. As of early 2026, its balance sheet had shrunk from a peak of nearly $9 trillion to around $6.65 trillion. This isn't a theory. And here's the part most people miss. This doesn't show up in prices first. It shows up in access. It's a direct mechanical draining of the very money that asset prices run on. So here's the real question. If liquidity is being drained this aggressively, why hasn't anything broken yet? The answer is something that should worry every investor right now. This is the most dangerous phase of the cycle. There's a critical delay, a lag, between when the money is removed and when prices finally react. Markets run on stories and momentum, and they look strongest right before they break. This is the phase where most people feel the safest and make the worst decisions. We saw this exact movie play out in 2018. The Fed was tightening, but for months the market ignored it. The story was, the economy is strong. Stocks kept climbing. Then, in the fourth quarter, reality hit. The S&P 500 plunged nearly 20% in a few weeks. Liquidity tightened first, but the sell-off came later. Right now, we are living in a 2018-style delay, but on a much grander scale. The gap between the path of liquidity and the path of asset prices is a measure of the market's complacency. And while everyone is focused on growth stories, the plumbing of the financial system is already flashing red. Let me show you what this actually looks like in real time. This is where it starts to matter. When you drain a reservoir, the lights don't go out right away. First, the water pressure drops. The turbines sputter. In the financial system, those warning lights are flashing in the funding markets, specifically the repo market. This is the pawn shop for big finance, where banks get overnight cash. In late 2025, the interest rate there began to spike, signaling there wasn't enough cash in the system for banks to operate smoothly. And when this market starts to stress, it doesn't stay contained, it spreads. And once it spreads, it becomes a system problem, not a market problem. This funding stress got so severe the Fed was forced to stop its tightening program and even begin reserve management purchases, a technical term for injecting cash just to keep the plumbing from breaking. Think about that. The Fed is being forced to choose between fighting inflation and preventing a financial crisis. They are being forced to choose stability. It's a sign the system is so addicted to cheap money, it can't function without it. Then there's the second crack, the mountain of cash sitting in money market funds, which has swelled to a staggering $7.8 trillion. The media calls this cash on the sidelines, ready to rush into stocks. But what it really is a massive vote of no confidence. It shows investors prefer the perceived safety of cash over a fully valued stock market. If you're focused on price, none of this looks like a problem. But if you're watching how money actually moves, this is exactly what happens before things break. And this brings us to the part of the system that only works when money is easy and breaks the moment it isn't: the trigger. It's a nearly $2 trillion sector that exploded in the cheap money era: private credit. And the problem is, a huge part of the real economy depends on it. These are non-bank lenders who funded a huge part of the corporate world when money was easy. But they have no safety net. There is no Fed bailout for them. As their own funding costs rise, their ability to lend freezes. This isn't a niche problem. A freeze in this market would create a credit crunch that chokes off capital to thousands of businesses. This is how a financial problem bleeds into the real world. This is where things stop working. Not in theory, in real businesses, real jobs, and real cash flow. So what does this mean for you? It means the system can look stable, while the ability to borrow, refinance, or transact is quietly getting harder underneath. But when liquidity tightens, money doesn't just disappear, it reroutes. And it always reroutes to the system that works best under pressure. The laws of financial gravity can't be defied forever. The gap between falling liquidity and high asset prices has to close. This is the great repricing. First, capital will flee from paper to real. It will leave speculative tech stocks priced for perfection 10 years from now and run toward the building blocks of the real economy: commodities, energy, industrial metals. In a world of financial uncertainty, owning the thing pulled out of the ground is safer than owning a story. But as the debt bomb starts to tick louder, capital will seek not just a different asset, but a different system entirely. The legacy financial system runs on slow, fragile plumbing from the 1970s, open only during banking hours. Now, a parallel system on the blockchain offers a stark contrast. It's instant, final, and global. That's why over $300 billion has moved into stablecoins, which settle dollar transactions 24/7, bypassing the old system's risks. And networks like Bitcoin offer a neutral settlement layer for final transactions without any central party. This isn't about speculation. It's a rational response to the friction of the old system. When you can't be sure you'll have access to liquidity, a system that offers instant, final settlement is the ultimate safe haven. So let's put the story together. A hidden force, global liquidity, is being drained from the system. The market, obsessed with a story of strength, hasn't reacted yet. We are living in the dangerous delay. But the cracks are already showing, from stress in funding markets to the Fed being forced to abandon its policy just to keep the engine from seizing. The great repricing isn't a question of if, but when. Capital will be forced to move, first into real assets, and then into a new, more resilient financial system. The shift doesn't happen when prices fall. It happens when access changes. And by the time you see it in price, it's already too late. The only question now is, where does the money go next? Because it's already moving.